So a few things have happened recently that we have to talk about. You're probably wondering how the new president, Joe Biden, is going to affect the stock market. Is his more generous stimulus package a boost for stocks? But then again, what if he raises taxes? Is that going to lower company profits and damage share prices? I mean, it's been a pretty crazy time for us all, and I think we all have quite a few questions. So I've been researching this stuff pretty thoroughly recently, and in this video, I'm going to share with you what the data says, what my research says, and what top investors think is going to happen in the coming weeks, months, and years. Welcome back to the channel. I'm Tom. I talk about investing and personal finance based on data and research. So if you like those kind of things, make sure to subscribe and smash the like button. Now, I don't know about you, but I'm not a big fan of videos that waffle on for ages and then eventually get to the point like 10 minutes later. So let's just get straight to it. If you're an investor like me, there's two main things that we have to consider. Number one, Joe Biden is the new president. And number two, neither party has the majority in the Senate. There is a split Senate. And if you don't know what that means, don't worry, I've got you covered. But first, let's talk about the new president. So to make this as clear as possible, I'm going to break things down into the pros and the cons for the stock market. I'm not going to get political in this video. I'm not going to talk about recounts or anything like that, because honestly, I don't think that I personally know enough to even add value to the conversation for you anyway. The first pro for Biden as president is that he wants to pass a much larger stimulus package worth over $2 trillion. Listen, this right here is a big deal, because ever since March 23rd of this year, the stock market has become virtually completely unrelated to the economy or even the profits that companies make. I mean, think about it like this. The stock market is higher today than it was at the start of this year and is at virtually all-time highs. That's at the same time as most companies are making far less in profits. The reason is stimulus. So if Biden can pass a large stimulus package, of course, that is bullish for stocks. The flip side of this, though, is that Biden has pledged to raise taxes for businesses. So the rate today is 21%, and Biden wants to raise it to 28%. Let's say you're running a business, and every month you're paying your employees, and you're paying the various costs. At the end of the year, you have profits. Let's say you have $1 million left over. Today, you'd pay 21% in tax, and that would mean paying $210,000 and leaving you with a profit of $790,000 after. If, however, taxes are raised to 28%, you'd only have $720,000 after you've paid those taxes. Or in other words, from 1 year to the next, even if your business makes an identical amount of money, you'd have $70,000 less profit. If two companies are identical in every way, except one makes less profit than the other, the company that has lower profits should be worth less. Now, if you take this and you apply it to the entire stock market at the same time, because they'll all be paying higher taxes, now we can see how companies in the stock market should, in theory, lose value. However, there are counter arguments to this. According to Goldman Sachs, the spending increase from the stimulus would at least match the likely longer-term tax increases on corporation and higher income earners. We also have to ask ourselves, how likely are these changes to be made in the short term? I mean, with businesses already suffering so much, is a tax increase really going to come until things have at least returned to normal? And the final thing to remember is that companies like Google, they don't really pay taxes anyway. So yeah, there is that. In the pros category for Joe Biden, we have Twitter. What do I mean by that? Well, markets above all else, they hate uncertainty. They hate change and they hate surprises. So when the president is able to tweet out something which catches the market by surprise and freaks everyone out, well, that's not good for the market. And while Biden will be able to use the official president Twitter account, I don't think anyone is expecting him to use it quite as much or as provocatively as his predecessor. However, while there might be less uncertainty with tweets, there is more uncertainty around regulation. Sectors such as technology and non-renewable energy companies, they've seen regulation largely lifted or not as strictly imposed over the past 4 years. With a new president, regulation is always likely to change, and that can damage the value of companies within those sectors. There's a flip side to this though as well, as analysts have noted how regulation and investment it may benefit other sectors. For example, Biden has vowed to expand the Affordable Care Act, which could be bullish for healthcare stocks such as pharmaceuticals and biotechnology firms. There could also be greater investment into infrastructure that could result in a benefit for the industrial and material sectors. So the question is Biden good or bad for stocks? Well, to answer that, let's look at some data. This chart shows us what happens to the stock market when the current president wins his second term in office. The blue line is when the sitting president wins. The black line is when the sitting president loses. As we can see, the stock market generally prefers it when the current president wins a second term. So based on this data point alone, Biden winning the election could be less positive for the stock market than if Trump had remained in power. And backing this up, JP Morgan discovered that in the short term, markets tend to react more positively right after the election of a Republican president. However, dating back to 1933, a Democratic president typically presides over a higher stock market than a Republican president. And then we consider the last Democratic president, Obama. There was fear surrounding how his election would affect the stock market, but ultimately this proved to be unfounded. In 2008, Wall Street was so alarmed by the prospect of Barack Obama becoming president that for a period of time there was an 80% correlation between the polls and the market. Every time Republican John McCain got a bump in the polls, stocks went up. Yet Obama was elected, and the Dow Jones Industrial Average, which closed at 9,625 on election day, ended up rising to a massive 18,332 in the following 8 years. So are you confused yet? Well, good. Because from my research, there is no clear answer, because whoever is president, the stock market just doesn't simply seem to care. Technically, a Democratic president has offered higher stock market returns, but even that is based more on timing than anything else. I mean, for example, George Bush, a Republican president, took over in the aftermath of the dot-com bubble. I mean, that stock market, it was headed downwards regardless of the president. History has shown that timing is the most important thing to determine the stock market under a president. In other words, presidents that come in at a good time generally see a strong stock market, and those who come in at a bad time generally have a weak stock market. Who is actually sitting behind the desk doesn't seem to matter that much. However, there is another factor in play here. The president does not decide everything. To pass a new bill or a new law, it's first brought up in the House of Representatives. If the bill is passed, it will move up to the Senate for review and negotiations. If the bill passes through the Senate, then it's up to the president. He can either sign his approval, in which case the bill will officially be passed, or he can veto it and send it back to the Senate, where the Senate will have to get a 2/3 majority vote to overrule the president's decision. So let's imagine for a second that the House of Representatives is filled mostly with people from the Democratic Party, and so is the Senate, and the president is Democratic too. Now, in this fictional scenario, the Democrats would work together as a team to approve a bill through the first, second, and third stage very quickly. And there would be nothing that the Republicans could do about it either, as they wouldn't have a majority position in any of the key areas. This was what many people and pollsters predicted would be the outcome of the recent election. However, it was not to be the case. It looks like the Democrats will maintain a slight majority in the House of Representatives, but the Senate is going to be split. There will be no majority for either party in the Senate, and this is a big deal. For a new bill or law to be passed, it will have to be approved by a Senate split down the middle, and that makes it so much more difficult to agree on anything. So the question is, what does that mean for the stock market? Well, you might be thinking to yourself, if they can't agree on anything, that's got to be bad, surely. But the truth is, the stock market has historically actually gained the most value under a split Congress. From 1950 to 2019, a Republican Congress has returned an average of 13.4%, a Democratic Congress 10.7%, and a split Congress tops the lot with a return of 17.2%. How does this make sense? Well, there is one thing that markets hate, and that is uncertainty. When one party has control over Congress, it makes it a lot easier for them to pass new bills. This means more change, and change is uncertainty. However, when things are deadlocked, it means fewer bills can be passed, and so less is going to change, which means less uncertainty. That is why the stock market loves a split Congress. And in fact, out of all of the possible combinations of the presidency and Congress, the market historically has performed the best with a Democratic president and a split Congress. In other words, the result of this election have historically been the best combination for the stock market. Now, I did say at the beginning of this video that my research was based on the data, and I want to be thorough with you, so you should also be aware of this. According to a study, the stock market showed less than a 6% gain during election years, compared with an 8.5% gain in any other given year. And according to the same study, stock market returns also tend to be slightly lower the year following the election compared with any given year. Now, just like you, I'm a regular guy just trying to research this stuff because I'm confused and I want to figure out what's going on. This video is just me showing you my personal research, and from what I can see, there are some key takeaway points. Firstly, everyone loves to debate how the president is going to impact the market. But the truth is, in normal times, the president has virtually no impact whatsoever. It doesn't matter if he's Republican or Democrat, the impact that the president has on the market is hugely overstated. However, I think there could be an argument to be made that this time might be different. And I know when you hear yourself saying the words "this time is different," you should probably stop yourself there. But just hear me out. In normal times, the profits of companies essentially determine the values of those companies. I mean, of course, right? When companies are performing well, stocks generally rise and vice versa. Well, at the moment, the stock market is running on stimulus and the Fed's interventions. And we know that because stocks are near or even at all-time highs, even though profits are nowhere near. So I think there's an argument to be made that if a large stimulus package is passed, it makes sense how this could be extremely beneficial for the market, and much more so than even in normal times. At the same time though, because Congress is split, it makes it far tougher to get any stimulus package agreed and passed through to the president. As a result, when that will happen is another story. For me, when I look through history, it seems like what is going on at the time is so much more important than who is president or which party is running Congress. I mean, the combination of a Democratic president and a split Congress, it has historically been the most positive for the stock market, but I think much of that just comes down to coincidence. Things like the dot-com bubble, the 2008 financial crisis, and everything that's happened so far this year, they're not related to either party, and it didn't matter who was in power at the time, the market was never going to perform well. It looks to me like what is going on in the world at the time is a far greater factor than who is in power. Now, that's my thoughts, but let me know yours. What do you think? Do you think the president has a great impact on the market, or do you think it's overstated? I want to hear what you have to say. Every Tuesday and Friday, I share videos like this on finance and investing, so subscribe if you don't want to miss any. And of course, thank you for watching.